Bank stocks getting slammed in today's sell-off with outsized losses for the major firms, including Citigroup, Goldman Sachs, and Morgan Stanley. And Morgan Stanley getting a rare downgrade today. The analyst behind that call, Wells Fargo's Mike Mayo, joins us now on the Newsline. Mike, it's good to have you. Let's start with your downgrade of Morgan Stanley. I believe you're the only one on the street now who is underweight. Why?
Well, it's been 12 years since the last time I had an underweight or sell rating on Morgan Stanley. Then it was coming off of the global financial crisis, and the stock went down to $13, and I was wondering about their viability. Then you had James Gorman come along, and he had a good team, including the current CEO, Ted Pick, and turn things around. Now, 12 years later, I'm putting a sell rating on the stock because I think at this valuation, close to $100 a share, they're pricing in returns that I don't think they're going to achieve. And half the company is really their crown jewel, and that would be wealth management and investment management. And that half of the company is valued probably 50% more than the other half when you look at your typical valuation metrics. But if you look at their wealth management business, great place to be a client, but they're not growing their new wealth assets as quickly as before. In fact, they're only growing at half the pace that they grew them 3 years ago. In fact, at the pace before they purchased E-Trade. So that valuable part's not growing as quickly as before. Their investment management business, also usually a higher valued segment, has seen outflows of assets over the last 3 years. Mm-hmm. And then a newer factor is they have, as part of their wealth business, they have a bank. And like banks have spread revenues, and those spread revenues are likely going lower. So you add it all together, you're not growing as quickly as much. You're seeing some outflows in investment management. You're seeing some pressure on kind of traditional banking revenues, and that's on the half of the company that drove their stock re-rating for the last 15 years. So at a minimum, that's plateaued, and if not, maybe it's come down. It'll come down and kind of get closer to peer valuation levels. This is the most expensive stock that I cover, and things aren't going quite as well as I think they'd like them to go.
Okay. And, of course, shares of Morgan Stanley finishing the day down about 6%. But we did see across the financials, and particularly the banks, we saw quite a bit of broad-based selling today and some very large moves. And despite the fact that Intel and Amazon were such big percentage moves lower for the Dow, it was actually Goldman Sachs, sort of speaking to this point, that contributed the most from a point perspective to the Dow falling more than 600 points. What is fueling this broader sell-off right now? Is it recession fears and the macro concerns of economic slowdown, or is it something else?
You know, at the start of the year, we had three scenarios. One was a base case, soft landing, 50% chance. One bull case where things are better than expected, 25%. And then a recession scenario of 25%. And truthfully, until the last few days, until this morning almost, with the unemployment data ticking up, people weren't talking so much about recession. And now the talk of recession is back on the table. Is that going to be short-lived or not? Waits to be seen. But whatever percentage you had for a recession before, it's probably gone back up. So I had 25% chance at the start of the year, and maybe we're getting closer back to where I was at the start of the year for a chance of recession. So you price in a greater, not probability, but chance of a recession. You also have interest rates declining quite a bit. In fact, I'd highlight the 5-year Treasury yield just this quarter has declined from 4.3% down to 3.6%. So there are some indications that things are slowing down more than expected.